The Eurozone economy shrank for a second quarter in a row, according to official data released Thursday, eliminating any doubt about whether the region was in recession and signaling that a long road to recovery still lay ahead. Gross domestic product in the Eurozone fell 0.1% in the 3 months through September compared with the previous quarter, according to Eurostat, the European Union Statistics Agency. The downturn was slightly less severe than in the second quarter, when growth contracted 0.2%. But it was the fourth quarter in a row of zero growth or worse. Perhaps more worrisome, the data showed that Spain, Portugal and several other countries remain far from the kind of recovery that would bring increased tax receipts and help them overcome their debt problems. European leaders, who have benefited from a tenuous calm on financial markets in recent months, are likely to face additional pressure to ease the government austerity programs that have undercut growth in southern Europe. Economists at Nomura warned of a depressionary environment in a growing share of the region. In a note to clients, they said, "This negative loop has the potential to threaten the stability of the whole system." Some analysts had forecast a bigger decrease in output. But France registered a surprise uptick in growth and the Italian economy shrank less than expected, moderating the pace of decline across the region. Considered along with sagging factory output and business sentiment, though, the numbers Thursday reinforced expectations that the euro area as a whole could remain in recession well into next year. An end to the recession in the Eurozone is still out of sight, Christoph Weil, an economist at Commerzbank in Frankfurt, said in a note to clients. Germany, which has the largest economy in the Eurozone, continued to defy the crisis. The country grew 0.2% in the third quarter, slowing from a rate of 0.3% in the second quarter. But data on exports, domestic demand and business sentiment indicate that growth in Germany will slow in future quarters because of falling demand from its neighbors. The recession is often defined as 2 quarters in a row of falling output, though many economists say it is important to take other data into account. But with unemployment in the euro area at 11.6% and nearly 26 million people out of work, few would dispute that the region is in a deep downturn. Leading indicators suggest that the Eurozone recession will broaden and deepen in the current fourth quarter, said Martin van Vliet, an economist at ING. The European Union, which includes the 17 countries in the Eurozone plus 10 more countries primarily in Eastern Europe, managed to return to growth in the quarter as several countries, including Latvia and Lithuania, recovered strongly. Growth for the Union as a whole was 0.1% compared to the previous quarter, after a decline of 0.2% in the second quarter. But in Western Europe the economic decline spread to Austria and the Netherlands, which had been growing in previous quarters. The Austrian economy contracted 0.1%, while the previously healthy Dutch economy plunged 1.1%, catching economists off guard. One reason for the decline was that Dutch consumers cut back purchases of cars, illustrating how the crisis in the European auto industry is having a broader effect. Slower export growth and a decline in construction also had an effect, according to Statistics Netherlands, the official data provider. France grew more than analysts forecast, at 0.2%, because of increased exports and higher consumer spending. The Italian economy shrank 0.2%, which was less than expected and a less severe decline than in previous quarters. Foreign demand compensated for a decline in household spending in Italy, economists said. There had been some signs in recent months that the Eurozone, now in its third year of crisis, was beginning to stabilize. The exodus of money from Spain had stopped and borrowing costs for Spain and Italy have dropped out of the danger zone, thanks to a promise by the European Central Bank to intervene in bond markets. Exports from some of the troubled countries have risen, as companies put more emphasis on foreign markets to offset poor demand at home. Mario Draghi, the ECB president, said last week that although growth would continue to slow through the end of this year, he expected a slow recovery next year. The data Thursday could raise expectations that the ECB will cut its benchmark interest rate, already at a record low of 0.75%, when its policymakers meet next month. But the ECB has already stretched its mandate to fight the crisis, and the burden may now fall primarily on government leaders. Germany could face added pressure to ease its insistence on drastic budget cuts by Spain, Greece, Italy and Portugal, especially after large protests in those countries this week. Eurozone finance ministers are expected to meet next week to consider whether to release the next installment of aid for Greece, which it needs to avoid defaulting on its debt. Next month, European heads of government will hold a summit meeting to continue working on ways to make the common currency area more resilient, for example by pooling supervision of banks. It is essential that the period of relative calm on financial markets is preserved, said Marie Deron, an economist who advises the consulting firm Ernst & Young. This will necessitate further quick progress on key reforms, including securing Greece's financing and moving towards a comprehensive banking union. But disputes remain on the future shape of the Eurozone, and there is a risk that leaders will not move fast enough. Economists said that much of the slowdown in business activity reflected uncertainty among managers, who do not want to invest until they are more confident of a recovery. The confidence shock will therefore continue to hinder investment and hiring decisions, Mathilde Lemoine, an economist at HSBC, said in a note.